Good evening, all the joinees. Hi, this is Ansu. I welcome you all to the webinar conducted by NGEN Markets. By the time the others join in, let's have a look at today's webinar topic. So today we will be majorly focusing upon various parameters that you can use to compare actively versus passively managed funds. Firstly, we will be using our robust query section to filter out both active as well as passively managed fund. Followed by that, we will be looking upon various comparing parameters like the tracking error, alpha, excess generated by the fund over that of the benchmark, beta, which lets us know the risk that a specific fund is taking, as well as the capture ratios, which lets us see how is the fund performing when the benchmark was in a bull or in a bear run. Followed by that, we will also show you a way how you could download the holdings of all the funds that you are having a look upon, majorly in the compare section. And we will be showing you the report that you could generate from the compare tab. And lastly, the quorum would be open for a Q&A session. You could either unmute yourself or type down your questions in the chat box below. So let us begin. So this is our landing page on NGEN Markets, which is the Markets tab. So for our topic related webinar, we would be moving towards this Funds tab. Now this is the section which helps us to filter out funds basis our respective filter parameter. And right here, we would be using the screener and the query tab. So the screener helps us to filter funds basis basic filter parameters that are available right here, while query helps us to build more advanced queries and filter out funds. So we say the query happens to be an advanced version of the screener, which gives us a chance to put in multiple conditions and build our respective query to come up with a specific list of fund that we are looking for. Now, since our topic for today is specifically depending on active and passively managed fund, in terms of passively managed funds, we do know that these passive funds come under the category of equity index fund as a SEBI categorization. Now, in this screener, how can you go about it will be clicking on this filter categories as an option. Once you do that, 4 buckets, which are the asset classes, comes up onto the screen. You can select the category right here by clicking on this checkbox of equity index fund, and the total funds that are under that category, which is 210, will show up onto this screen. So by default, on the screener section, we show only the top 50. However, you have an option to increase the list of funds. You just select 300 is what I've selected, and I click on apply, and now the entire list of 210 funds will get loaded. Now, let's say from this index fund, I am typically trying to locate a fund which piggy banks Nifty 500 as a benchmark. Now, in order to identify that from this list of 210 funds becomes a hassle or becomes very difficult that way to manually search for it. In this situation, you can anytime make use of this robust query section. So in this query section, as I highlighted, there are multiple filters. Once you arrive at this select statistic filter option, multiple filters are available, be it basic filters, or for that matter, the returns or risk related filters, followed by the holdings and yearly returns related filters. Multiple filters which can be used as conditions to create your respective query. So for today, as we know that we are looking upon passively managed fund, which come under equity index fund as a SEBI category, the first condition that I will be using or putting forward will be this option of SEBI category. Now, within SEBI category, I am looking for a specific category that is exactly, I click on this drop down and I select my specific category that is exactly equity index fund, and I click on add condition. So it says basis this one condition, there are 210 funds. Now, next parameter, as I mentioned, a fund which piggy banks Nifty 500 as a benchmark. Now, for that, in this query section, we can use the filter of fund name right here, which is to say that this fund which piggy banks Nifty 500 will anytime have Nifty 500 index in its fund name. So I will be simply typing right here Nifty 500 index as the fund name, which should exactly match basis what I'm looking for. And I'll click on add condition. So you see, sorry, from 210, we are now come down to just 4 such funds, which is meeting my respective parameter of fund name as Nifty, sorry, Nifty 500 index fund. So our hassle of looking out for a specific fund from a list of 210 funds has gotten reduced just by inserting this specific fund name condition. Now, all you need to do is click on this option of show 4 funds, and on this right hand side, you will be able to see the list of funds accordingly coming up basis the conditions that you have input. Now, in addition to this, I will also want to put a condition of the time period for which the fund was there in the market. So a age parameter apparently. So I'll click on this drop down. I'll select this option of launch date and I'll edit the end date as May 2022 and I'll click on add condition. Right. So basis this one condition that again I put in based on the age, it says finally there is one such fund only meeting my respective parameter. And I'll click on this show one fund and my fund has now come up to be Motilal Oswal Nifty 500 index fund. Now, next to the name of the fund, you could see that there are 3 columns coming up. Now, these 3 columns are respective to the conditions that we have input. More would be the conditions that you input, more, and accordingly, the columns will also come up. These are limited to the conditions that you put in. Now, there are 2 things that you could do once your list of funds come up into this query tab. First is either you could download an Excel data of the same. If not, you also have an option to click on this compare icon and take your list. Currently, since it is just one fund, we are taking this fund to this compare section, wherein we could run an analysis of this fund with the active fund as well as with that of the benchmark. In addition to that, this query section also provide you an option to save the query that you've just created. Once you do that, you just simply put in a name of this respective query. The next time you come onto the platform, you do not need to manually put in all these conditions. You just come to the query tab, click on load saved query and select your respective query that you've created. And then you can simply click on show the number of funds and your list comes up accordingly. So saving of a query is anytime possible onto the platform. Now, once we have shortlisted our passive fund, we will now be looking upon the actively managed fund. So we know that a specific category that follows Nifty 500 as a benchmark is a flexi cap category. So in order to select fund from that category, I will make use of the screener section. So I'll go to the screener, select filter categories, and I'll select flexi cap as a category, and the entire list of 39 flexi cap funds will now show onto this screen. Now, from this list, let's say I want to select 2 or 3 best performing funds based upon its 3-year return. So, 2 ways to arrive at that 3-year returns column. Either you could scroll towards the right, multiple columns available, you can locate your respective column. If not, we have provided right here certain preset column views. You could click on this drop down and select your respective columns. So I've selected returns column, and right here we could locate the 3 years return for these funds. So I'm just clicking on this column heading. You click on any of the column heading, your data can get arranged either in the ascending or in the descending order. So basis the 3-year returns, you could see that the best performing fund happens to be JM and HDFC Flexi Cap, followed by Motilal Oswal Flexi Cap. So let's say from this list, I just want to take the top 2 funds and move it to the compare section. How do you move just these 2 funds is by simply clicking on this add to compare icon, which is mentioned which is mentioned towards the left of the fund name. And then I go to this compare tab. And here you see our active funds as well as our passive fund has gotten added in. The next step would be to add the benchmark, which will be Nifty 500. And the option to do that is just right here, add other items. I would search for Nifty 500 and you click on that and it gets added in right here like a row item. So this is differentiated by a color blue so that you can identify that this is be it a benchmark or a category average, and a differentiation of these benchmark with that of the funds that you're looking upon. Now, when we are talking about active versus passively managed fund, the first thing that you can look upon will be the expense ratio. So, expense ratio refers to the amount that is required to manage that respective fund. And on our platform, you could find it mentioned as TER, the very third column. So, this stands for total expense ratio. So right here, we could clearly see that the expense ratio for both our active fund, which is JM, has an expense ratio of 1.7 and HDFC has an expense ratio of 1.40, which is typically higher, and rather it is suggesting that the fund manager is trying to do something different from that of the benchmark and hence a higher expense ratio. While when we look for this passively managed fund, the expense ratio is comparatively lower, which is typically saying that no additional input or strategy is put in by the fund manager to make this fund outperform. Once we have looked upon the expense ratio, I'll come towards these columns, which are CAGR, standard deviation, Sharpe, Sortino, and value at risk. By default, when you bring funds to this compare section, these columns will show data since the inception of respective funds, which is to say that a standard deviation of 20.9 for JM Flexi Cap is the standard deviation since its inception. Now, let's say I wish to view the volatility of these funds for a time period of 3 years in the past. So for that, I'll click on this settings wheel right here in this returns column, and I'll put in a time period of 3 years. So I'll take in 2022, 20th May, and I'll click on go. Now, these data are respective for the time period that we have set in, and we also get a prompt saying that we have input a custom start date. Now, if I sort this basis its volatility, which is the standard deviation, we could see that the highest risk has been taken up by this active fund, which is JM Flexi Cap, to an extent of 15%. However, this risk is any time compensated by the level of return that this fund is earning. It has a CAGR to an extent of 26.5%. And similar is for HDFC Flexi Cap. Risk is anytime compensated by the returns that it is taking up. While for our passively managed fund, both risk and returns are similar to that of the benchmark, that is Nifty 500. Risk, again, the fund is taking to an extent of 13.5, while for the benchmark, it is to an extent of 13.6. So typically saying it is just piggybacking how the specific benchmark is performing. Once we are done through these, we will specifically try to locate and identify the relative columns, and for that, we will move towards the right-hand side. So we come towards these pink color-coded columns, which are currently empty. You need to activate them by clicking on this checkbox of relative returns. So the data gets populated, and by default, it will pick up a benchmark of Nifty 50. You anytime have an option to change the benchmark under consideration. In addition to that, you also need to set in a specific start date in this relative returns column. So we anytime say that the start date mentioned in the returns column should be similar to the date that you mention in the relative returns column, so that you can have a fair apples to apples comparison of the data that you're looking upon. So here as well, I'll set in 20th May 2022. Right. Now, the first parameter that we will come across is cumulative excess. So as the name suggests, cumulative, which is typically absolute or point-to-point excess return generated by the fund over and above that of the benchmark. So in terms of cumulative return, we could see positive alpha is something that is generated by both our active fund, which is JM and HDFC, suggesting that the strategies adopted by the fund manager has indeed worked in favor of the fund, and the fund is able to generate a return over and above that of the benchmark. While if we look upon our passively managed fund, this is given a negative alpha, which is to say that neither has it tried to beat the benchmark nor its performance is similar or at par with that of the benchmark. And we could see a negative alpha to an extent of minus 1.18%. Next to that, we come to this annual excess, which lets us see on an annual basis what is the excess return generated by the fund over and above that of the benchmark. Now, annual excess is arrived by a division of cumulative excess with the number of years under consideration, which is to say that this figure of 13.24, how do we arrive at this is, it is a simple division of this cumulative excess, that is 39.9, with the time period under consideration, which is like a 3-year time period. So 39 divided by 3, that is how we arrive at this annual excess figure of 13.2. Next to that, we have this beta as a column heading. So beta lets us know how riskier a fund is when we compare it to that of the benchmark. So beta of a benchmark with itself will always be 1, and a beta higher than 1 lets us know that the fund is more riskier than that of the benchmark, and a beta lesser than 1 lets us know that the fund is less riskier than that of the benchmark. Now, here we see there indeed is a fund, which is JM, who has a benchmark higher than that, who has a beta higher than that of the benchmark, which is to an extent of 1.04. But any time you could see that this risk or this swing is compensated by the level of return that the fund is earning. Although taking in a higher level of risk, it is anytime able to generate a higher level of return. While our other actively managed fund, HDFC FlexiCap, risk is comparatively lower than that of the benchmark, but yes, it as well is able to generate a higher level of return to compensate this level of risk that is undertaken. While for our passively managed fund, the risk is indeed similar to that of the benchmark at 0.99, typically suggesting nothing extra or different has been done by the fund manager to deviate its performance from that of the benchmark. Next to that, we have this tracking error, which lets us see, or as the name suggests, it lets us know how effectively and efficiently the fund is tracking the performance of the benchmark. So tracking error majorly becomes useful when we are analyzing a passively managed fund. So we do know that the tracking error for an actively managed fund should anytime be higher. And that is what we could view right here. For both the active funds, the tracking error is 4.5% and above, suggesting outperformance and excess strategies put in by the specific fund manager to outperform this respective benchmark. Now, how do we arrive at these tracking error figures that you see? So this is calculated as a standard deviation of excess return generated by the fund against that of the benchmark. Next to that, we have this information ratio. Now, information ratio is calculated by taking the ratio of annual excess as a parameter with the tracking error. So tracking error becomes one component for calculating the information ratio. So this will typically show you the skill of the fund manager in terms of managing the fund. So if the alpha is positive, right here, if the alpha is positive, which is to say that the fund is outperforming the benchmark, the information ratio will also be positive. And we say that higher is the information ratio, better are the fund manager's strategy, and it is indeed effective. And similarly converse, if the alpha is negative, indeed the information ratio will also be negative. Post this, we have two other parameters, which are these capture ratios, up capture and down capture, which lets us know how is a fund performing when the benchmark was in a bull run or in a bear run, respectively. Now, in order to understand these in detail, we would load a fund in a new page. So I've just clicked on the name of the fund, HDFC FlexiCap, and it has opened up in a new page. And we would go to this tab of fund performance, and I'll simply scroll down to locate the capture ratios, which is up capture and down capture. Before explaining this, I would just try to change the time period that is under consideration. I'll bring this back to a time of 3 years, what we had set in our compares mean list as well. And now we try to understand this capture ratios. So up capture lets us see how did the fund perform when the benchmark was in a bull run. Now this parameter of 106, how did we arrive at this is you could click on this I button for a detailed explanation. So in this up capture data, we we would consider only those months wherein the benchmark generated a positive return, irrespective whether our fund generated a positive or a negative return. We would give in consideration to the benchmark returns, and correspondingly, whatever were the returns for the fund, we would just mention them right here. Once the data are available, we would be taking in a CAGR of these data sets, and that is the figure that comes up mentioned right here as returns. For the fund, it is 54.9, and for the benchmark, it is 51.6. Now, how do we arrive at this figure of 106? It is a plain division of this fund return, which is 54.9, with the benchmark return, which is 51.6. Now, we say higher is the up capture ratio, better is the performance of the fund when the benchmark was in a bull run. And by higher, we mean more than 100. And similarly, converse will be the down capture ratio. Here, we would be considering only those months wherein the benchmark generated a negative return. And correspondingly, whatever were the returns of the fund, we would just mention them. In a similar way, we would take a CAGR of these data sets and arrive at this figure that you see onto the screen by a plain division of this fund return with that of the benchmark return. And again, for down capture, we say lower the better, which is to say that lower than 100. So a figure of 64, which says that yes, the fund is indeed resilient when the benchmark was in a bear run. And the reason why we say as above 100 and below 100 is typically because we consider the benchmark to be at 100. So above, the better is the up capture, and below 100 is the better down capture. So this was the explanation of the up capture and the down capture ratio on a fund level, which is anytime also available on a portfolio level as well. So we again come back to the compares tab right here, and the next topic we will be looking upon would be the position overlap. So the position overlap lets us see the common underlying, the common holdings between every two fund that you load to the compare section mean list. Now, this is a matrix structure that you can come across, and in order to read the data, you just need to keep your cursor on any of the tile that you see. And two funds will get highlighted, one on the left, which is currently HDFC FlexiCap, and one on top, which is currently right here, Motilal Oswal Nifty 500 Index Fund. So this is saying that both the funds have common overlaps or common underlying to an extent of 35%. Now, where is this coming from? You could click on this tile and view their common holdings. So it says HDFC and Motilal Oswal Nifty 500 has all these components, all these underlyings in common. Now, how do you read them? It is to say that, let's say we look upon HDFC Bank as a stock. So it says HDFC Flexi Cap has HDFC Bank as a stock to an extent of 9.3%. And in a similar way, Motilal Oswal Nifty 500 Index has the same stock, HDFC Bank, to an extent of 8% approximately. So the minimum out of these two holdings, which will be 8.02, will be considered in this overlap column. And once we take a total of this overlap column, it comes up to 35% that you could see just right here. And on the platform, we have also provided you with certain color coordinations as well. So as soon as the overlap keeps getting darker or the tile color keeps getting darker, suggesting that the overlap is going beyond 40%. It could be yellow, pink, or red. This is typically to let you know that the overlap is higher and decision needs to be taken to keep either of the two funds in the portfolio because they have similar underlines that way. In addition to that, we also have a column towards the left, which will show you the minimum common holdings. That is to say that, let's say there are multiple funds that you're loading. Currently, we just have taken 3 funds. Now, in these 3 funds, it says that these are the list of stocks that are common across all these funds. That is HDFC Bank, ICICI Bank, all these stocks are common across all these 3 funds. You can also have a look at their percentage by clicking on this plus icon. So each funds and their respective holding into respective stock is what we show right here. Now, let's say we just want to look upon the holdings of these respective funds, for that matter. Let's say this index fund. We know that since this is a index fund, this will anytime have a holding to an extent of 500 because it is piggy banking Nifty 500. How you could locate that is you go to the main list and you can come towards this blue color coded columns, which is mentioned as number of holdings right here. So clearly you could see this index fund having a holding to an extent of 503, while both our flexi cap has the holding which ranges between a 50 to 70 number of holdings, which is to say, even with a lower level of holdings for these active funds, the fund is able to beat the benchmark when we compare it against that of a passively managed fund. Now, if you wish to view the holding of each fund individually, there are 2 ways how you could go about it. First is you open a fund in a new page right here. You could go to the asset allocation tab, and the first page that opens up within asset allocation, that is the overviews tab, will show you the holdings column, which can anytime be downloaded in Excel, which will be the latest data. So on our platform, we update the holdings from 8th to 13th of the month. This is one way how you could look upon the holdings of a single fund. The next way is, let's say you wish to view the holdings of all these 3 funds in a single Excel sheet. You could come to this last tab in this compare section, which is the bulk download, which will help you download the current holdings of all the funds that you load to this compare section. So this is how the Excel will come up. All the funds and their respective holding as on the latest date can be generated in a single Excel sheet. So once you scroll down, you will be able to see the list of the second fund. The holdings of the second fund will come up that way. Right? So the entire fund will come up into a single Excel sheet and their respective holdings as well. Next to that, we will move towards this risk versus return scatter plot, wherein on the x-axis, we take in annualized risk, that is standard deviation, and on the y-axis, we take in annualized return. And we've divided this scatter plot into 4 quadrants, that is low risk, high return, low risk, low return, high risk, high return, and high risk, low return. Now, this feature, which is differentiating the annualized risk and annualized returns into quadrants, this was something that we recently launched. So we typically take the midpoints of the data that you see on the x-axis as well as on the y-axis. Now, this will typically plot the funds based on its risk and returns in either of these quadrants. So if a fund gets plotted on this left hand side, we would say that those are the ones which have lower level of risk. In comparison, if the fund gets plotted on the right hand side, we would say that they have higher level of risk. And in a similar way, if the fund gets plotted on the upper end of this y-axis, they would have higher level of return. In comparison, if it gets plotted on this lower end of y-axis, it would have lower level of return. Now, you also have an option to change the time period for which you're viewing these funds movement based on its risk and returns as a parameter. So let's say here as well, I take in a time period of 3 years and I'll click on go. So right here, in a similar way, what we saw in the main list, we are also able to see in this scatter plot of risk versus return that JM is the one fund that is there in the high risk, high return quadrant, saying it is taking in a higher level of risk, but as well is able to generate a higher level of return. And HDFC Flexi Cap happens to be on the extreme left hand side, saying it is taking in a lower level of risk in consideration to JM, but yes, is well able to generate a higher level of return. While if we look upon this index and this ETF or this index fund that way, we could see that they are closed or placed somewhat closer to each other, which is to say that, of course, this fund, being an index fund, is trying to piggyback or copy the performance of the benchmark. In terms of risk, the index as well as the index fund is taking in a moderate level of risk, but is indeed generating a lower level of return when we consider it with those actively managed funds. Now, this data that we view in this compare section, we could as well generate a report for the same, which will be a PDF report. So this is how the PPT report will come up. Right here, you would be able to see your company logo in place of NGEN Markets. So the first page will give you basic information about the components, be it the fund or the mutual fund that you've taken to the compare section. Followed by that, risk and return related details for the funds. Then is the scatter plot of risk versus return. Followed by the holdings, which is to say that it shows you the large, mid, and small cap split of each of the fund. Followed by the overlaps, which is letting you know the underlyings of every two fund with each other. Followed by that is the performance chart, which shows you the NAV movement when it is rebased to 100. Next, we would be able to see the returns chart, the periodic returns, the relative returns. So this was as well a new slide that we had added into this compares report, this relative returns column, which shows the cumulative excess, alpha, beta as well into this report. And followed by the calendar year returns and the rolling returns. And PPTs on our platform are anytime editable. So you could add slides, remove slides, add in your recommendations or comments as well. So that is it for the topic related webinar. You could either unmute yourself or type down your questions in the chat box below.
Hi, Abhishek here.
Yes,
Can you also please explain how to read the VAR, the value at risk measure for the funds? If you
yes,
can
sure.
explain that word.
Sure. So I'll just do that on a single fund. So we anyways have HDFC FlexiCap opened up right here. So the time period that is taken under consideration is a 3-year time period. And I'll just go to this fund performance. I'll scroll down and VAR mentioned right here is an abbreviation for value at risk. What is the value of this fund that is at a risk? At a risk of what? At a risk of losing. So here you could see 95 has been mentioned, which is the confidence interval. So it says that with a 95% confidence interval, there is a 5% probability. Now, what is the 5? 100 minus 95, that is 5. So with a 95% confidence interval, there is a 5% probability that if history were to repeat itself, the fund can go down by a total of 17.21%, while the benchmark can go down by a total of 21.4%. Now, if we put this in simple terms, let's say 100 rupees is invested in both the fund as well as the benchmark. The capital erosion for the fund will be 17.2 rupees, while the capital erosion for the benchmark will be 21.4 rupees. And right here, you see 95, which is the confidence interval. We say that it is an industry standard to mention this confidence interval as 95, 90, or 99 that way.
Okay, and the implied means, is it that the outlook? basically
Uh,
to look
right.
forward?
So here, historical and implied, the only difference right here will be the parameter that is taken under consideration. The calculation remains exactly the same. So for historical VAR, we take into consideration the historical returns. While for implied VAR, we take into consideration the historical volatility. The method of calculation or the understanding remains the same. The only difference will be the parameter, which is historical returns in the historical VAR and historical volatility in the implied VAR is what we take.
Can it be safely assumed that if at all I choose this fund to invest, there can be an implied value at risk of this number basis whatever historical values have suggested? Is that what we can safely assume, and is that what 95% can be right?
Right. Basis, correct. Of course, basis if history were to repeat itself. That is what we say right here.
Okay, understood. And this can be done for any time period as well as since inception as well.
Yes, that is correct. All you need to do is change the time period that is under consideration.
And the benchmark here is the benchmark of the fund, Nifty 500
Yeah,
TRI.
Nifty 500 is what has been mentioned. You could search for that TRI as well, just from this list of TRI.
Okay, understood.
Hi, ma'am. This Pramod here. Um, I have a query slightly
Yes.
away from this topic.
Yes.
When we look at Sharp ratio, I was checking that on the fact sheets given the numbers are way away.
Hmm.
Is it because the risk-free returns taken is different, or I mean, what is the risk-free rate we take in the NGEN Markets platform like?
Uh, right. So typically, answering the first part of the question, on our platform, we do these calculations on a daily basis. So every parameter that you see on the platform, be it volatility, sharp, Sortino, we do these on a daily basis that way, right? So that is how
Right.
we might, that could be one of the reason which is typically differing the data that you see on the fact sheet as well as on the platform. We are very clear that we do that on a daily basis. In terms of risk-free rate of return that we take in, that is as well available on the platform in the markets tab itself. So 10-year government bond yield is what we take as a risk-free rate of return.
All right. But when the fact sheets, they give different other assumptions for their calculations. So that could also be one of the reasons, right?
Sure.
Yeah, hi, this is Arunabh here. Just to add to this, we did have a similar query before. I think it was for 360 mutual fund. As Ansu mentioned, I think the main reason is the frequency of data that we're using. As you know, in the Sharpe ratio calculation, the denominator is the standard deviation of the volatility. Most of these fact sheets seem to be using monthly returns or monthly NAVs to monthly returns to calculate standard deviation. So if you sometimes compare the standard deviation over the same 3-year period, what the fact sheet is saying and what we are saying, it's actually quite different. And that standard deviation then directly affects the Sharpe ratio calculation also. And that's one of the main reasons. So we always use daily frequency data to calculate volatility. So sometimes you will see that the volatility we are saying for one fund is quite a bit higher than what is on the fact sheet, and that is because that volatility or standard deviation is calculated on the daily variances rather than just monthly variance. Monthly will only be 12 data points. They may not move around that much, but intra-month, obviously, lots of things are happening. So from whatever we've seen, the main reason for the differences in Sharpe ratio and standard deviation is the frequency of data that is used for these calculations.
Okay, got it. Thank you.
Hey, Anshu.
Yes.
Anshu, can you go to that funds tab first? I have certain query which I would like to show you.
Sure.
Just go to the funds, select multi-cap category,
Okay.
and load the data and take it to that top 50 to compare.
Okay. Just a minute. I'll just remove the funds.
Yeah, please.
You just want the entire category, right? So I'll just add it
Yes, I
from
want the
here
entire
itself.
category. Yeah. All multi-cap.
Yes.
Yeah, just set 3 years back in return columns and relative return, put a check on relative returns. Benchmark is need to change 50, 25, 25.
Yes. So I've just taken 20 May 2022 works, right?
Yeah, it's
Returns.
fine,
Yeah.
fine.
Right. So in the relative returns, sorry, you were mentioning?
It's benchmark is 500 showing 50, 25, 25.
Ha.
Now just move to cursor that to do that relative returns column side. I found that whenever I download the monthly data, I never found that down capture ratio into this. Only up capture is showing there.
Yes, so that is typically because of the start date that you could see right here, which is 20th May 2025. So, in this entire category, if you see, it
Yeah.
is to say that there is a young fund which hasn't even completed like a month's period. So, what you will be required to do is you will be required to remove that young fund. Right, so you can see that this is the fund, right? UTI multi-cap. This is not even completed like a month's period into
Okay.
the markets, right? So what you can do is right here you can remove these young funds. So I'll just click on this delete icon.
Any fund which is there any limit onto this, that 1 month, 2 months, 3 months, or a year?
No, so but that will limit you from going before the date that you see right here, right? Now you see the
See,
date has
just
changed to 3rd March 2025.
okay. Is it
Right?
showing now?
Okay, just a minute. So apparently the other reason can also be that in the time period that you're taking under consideration, the benchmark did not give in a underperformance.
No,
Right?
but you see from 3rd March to this 2 months, well, highly volatile.
Okay,
March was
just a minute. We can
even
also,
you can remove 1 or 2 funds apart from that.
okay,
Just
just
let's
a
see
minute. We
because
can also have a look at it. It's 3rd March 2025, right? Right here. So you could see the month that was under consideration. The benchmark never gave a negative return, and hence it is coming up in the up capture only. There is no month when the benchmark
okay.
generated a negative return.
Okay. But just move back and just remove 2, 3 funds more from this
Yeah.
Bajaj and all that.
Yeah. I'll just keep it
Bajaj,
as a
Grow, and
1 year
set.
time period then.
Yeah, let's
And
keep.
yeah, I'm just
Just
removing all
remove
the
the
young
top
funds.
top 5 funds out of
Yeah,
this.
yes.
You can keep Motilal. Just tell Franklin you can remove that also. Because we download monthly data just to analyze. In
Sure.
certain cases, it was an observation.
Right. So the down capture has now come up. And you see the date has also changed to 13 September 2024. So we do have
Okay.
enough months to see that, yes, there were also months when the benchmark gave a negative as well as positive return, and hence both the columns are coming up.
See, tell me, because we need to evaluate an entire category, because you never know that which funds are performing in last 3 months or maybe 6 months, because there are certain funds or may not be performing 6 months or maybe 3 months time and all that. They may be turnaround stories. How to evaluate this data without impacting the entire data columns? Because I can't just remove. I can understand that okay, any fund which is below three months, I will not take into consideration, or maybe 6 months. Will it suffice that any fund which is below 6 months, I will not consider and will get the entire data proper over there?
Well, hi, Arnab. I mean, the main issue that we have is that when you have funds which have only 3-6 months data, because this is a comparative screen, right? We have to kind of show the analysis over the same time period for all the funds in the list. So we don't want to, for example, show you the up capture of one fund over 2 years, while the up capture of the other fund is over only 3 months. So we never let the system do that. Otherwise, it could be misleading for you. So because of that, there are some of these irritating things that happen because of this, that you have to remove the young funds if you want to do at least a 1-year analysis. And that way, at least the time period is kind of constant across the fund, so that at least the numbers are making sense versus each other. So it is not an ideal situation, but I mean, this is kind of the best solution we have Because obviously you're right that new funds are coming in all the time, and we can't just ignore them. So, I mean, we on the screener, when you look, it just shows you everything since inception, whether it's a 15-year-old fund or a 6-month-old fund. So there you can get that data, but in the compare section specifically, these kind of restrictions have been put in place, where if you're comparing a small or smaller set of funds in one place, that the time periods have to match.
No, I got your point.
Yeah.
See, I don't mind that. See, whatever you're saying is right. See, we have in a query, we can run a query of funds which are in 1 year category or maybe 2 years.
Yeah.
I can ignore funds that which are more not older than 2 years, and should be any tab over there where I can check that the funds which has been introduced in specific period of time, like it's too old, only 2-year-old funds.
Okay, that you can do quite easily. Ansu, let's go to the fund section. Select multi-cap screener here. Select multi-cap in your
yes, sir, it's already selected.
Yeah. So, and here you can do the minimum age, right, on the top. So you can say minimum age 2, and then apply, and now you get a smaller list, and you can then add these to the compare section.
No, I'm saying contrarian view. See, I'm saying that funds which are introduced in last 2 years, which don't have the age more than 2 years.
Oh.
Maximum.
Oh.
Yeah. So if I need to evaluate the new funds, I should have a data window where I can analyze these funds.
Yeah. Ansu, is it possible in the query? Can you just check quickly?
Yes, sir. Just a minute.
It might be. Yeah, I understand. Let's see if that can be done here. If not, then we can definitely build something.
I think maybe edit the start date, right?
Yeah, you can do start date of 2 years ago.
I think that it will work.
Yeah. So hopefully, right? Let's see. Yeah. Yeah, there you go.
Yeah, 23.
And actually from here, you can add these to the compare list.
I can put it in the compare section. Huh?
Yeah.
Yes.
That's a great one. See, I can filter the noise out of that performing ones also, and can evaluate that newly formed funds and go to comparison over there that these are the out of these new category of funds, which one is performing better. Then I can keep that fund to that other main category and remove the rest.
Sounds good. Ansu, please, let's make a note of fixing the date format on this launch date column.
Sure, sir.
Thanks.
Thank you so much.
Thank you.
Right. So there's also a question.
Hi. Hello.
Yes. Go ahead.
Yes, ma'am. I have a question. If I have multiple funds like in a multiple categories, so how can I check the category of the holding? Like how much is the large cap, how much is the mid cap in the entire funds portfolio? Like I have a mid cap, I have flexi cap, I have multi cap, I have multiple funds.
Sure. So what you could do is bring the funds to this compare section. Your entire list, be it any category fund, you could bring it to this compare section. And right here, you can move towards the right-hand side in order to come towards these blue color-coded columns. So right here, we have these column heading as large cap percent, mid cap percent, and small cap percent. So this will let you know the large, mid, and small cap split of every fund that you're looking upon. This will anytime be the latest.
If I want to know for the entire portfolio, for example, I have 10 schemes. How much is the total large cap in the total 10 schemes? How can I do that?
On a portfolio level, you're asking, or on a single fund level, are you asking?
On a portfolio level.
Portfolio level. Okay, sure.
So just to add, what he might need to say is, if we are selecting, suppose 5 to 7 funds, which is to go as a recommendation for that matter, then we want to know how much would be the large, mid, and small across those funds that we have selected.
Yes, right.
So I'm just loading a portfolio, and in the asset allocation, you could go to this concentration tab, which you can locate equity market cap exposure. You can view this in 2 formats as percentage of total portfolio. So when you look upon as percentage of total portfolio, you could view the bifurcation in terms of large, mid and small cap split. And there's also a pie section of others as well, which is to say that everything other than equity that is classified into this portfolio, everything other than equity comes up in this others pie section. The other option that we have is as percentage of equity exposure, which is to say that we are changing the equity exposure. We are changing the equity exposure to rebasing it to 100, and then we are splitting the large, mid, and small cap that way. So
and just to add, this will work if you equally weight all the funds, and that way it will be uniformly look at all the funds in the list.
No, I think what the question was, suppose I choose two funds, one flexi cap and one multi cap, and I put it on the compare tab. On those two schemes, if I have to look at the large, mid, and small cap exposure, I don't need to go individually to check because that I'm aware of. But as a selection of funds, like what we are comparing, can we see it like can it come on a single page
Oh
on those
yes,
multiple funds?
in
Yeah.
the compare section, let's just show the tabs further to the right, the holding columns.
Right. So this was initially shown mentioning the large, mid, and small cap slip. This is on a fund level that we are showing. The Mr. Rajput mentioned on a portfolio level is what he wanted to view. So that is why we just moved towards the portfolio tab.
We can also do a sum of the total, na? Of the sum.
No, so what he meant by the portfolio level total was, suppose I select 5 funds to create a portfolio. On that, what would be the total exposure types? Am I right, Mr. Rajput? Is that what
Yes,
you
yes,
mean?
yes, yes.
So,
Yes.
so then what we showed you in the portfolio section, that would be the right answer, because let's go back to the portfolio section. If you imagine this is the list of the funds, let's just stop on the top here. If you imagine these are the funds, we've given equal weightage to each of them. So basically, this is effectively what you see at the bottom is the average. Is the average large cap exposure, average small cap exposure, average mid cap exposure. Obviously, if you do sum, I mean these are percentages. So average would probably make more sense in this case, right? So this is the average across the funds in your list, which is why I said you have to have it equally weighted so that you can get an average number here.
If I change the weight, then it will change, no?
Then it will change things, because then you're saying I'm going to put a little bit more money on this fund, little less money on that fund, and that will affect this also.
Okay. So can I extract or export in the PDF on what file? On the Excel file?
Yeah, you have a PDF, you have a PowerPoint, you have Excel downloads as well. So PDF and PowerPoint you can download anytime.
Okay. Thanks.
No.
All right, so there's a question in the chat box. Can you explain tracking error once again? Sure. So I'll just go to this compare tab right here. Tracking error is something that you could find in this pink color coded columns, which needs to be activated by clicking on this relative returns checkbox. You need to select a benchmark and as well take in a time period under consideration as well. So tracking error is typically a parameter that is useful when you're analyzing a passively managed fund, which lets you see how effectively the fund is tracking the performance of the benchmark. And this is that way calculated as standard deviation of excess return generated by the fund above that of the benchmark. So for active funds, the tracking error would be higher, and for passive funds, it will be comparatively lower that way. There's also one more question in this chat box. Need to find the 3, 5, and 10-year returns of funds at the same place. How to go about it? So you could load those funds into this compare section, make use of the funds and the query tab to bring the list of funds to the compare section right here. And in the returns column, if you scroll towards the right, we have these columns mentioned as 3, 5, 7, 10, 15. So for all the funds that have completed the respective time period, the data will come up accordingly. And as well, in the fund section too, You could view the same data in the screener as well. I'll just select this returns column. And here as well, there are columns mentioned as 3, 5, 7, 10, 15 as well. All at one place as well you can look for. Any more questions? Please let us know.
Hello. Myself Abhishek here. Just wanted to tell that the injection date, which is mentioned, say in engine platform and on the fact sheets of that respective fund.
Sorry, your
Why?
voice is not audible. It's cracking a lot.
Hello, am I audible?
Yes.
Yeah. So I wanted to let you know that the injection is mentioned on, let's say, on your platform and on the respective fact sheet of that fund. Why these date differ? Like
What date? Inception date are you mentioning?
inception date. Yes. Launch date.
Which fund are you talking about? If you can let me know.
I have seen in almost all the funds on your platform.
Yeah, I think this may be because the inception date, what we show is basically from when the data, the first NAV is available in our database. So we obviously have all the mutual fund data, but the launch date here typically always refers to the data start, the start of the data basically. So it could be that the inception is when maybe the fund legal entity was formed. And they started trading later on. But we can have a look at it. We'll check with our data provider. But this is something that is provided initially by our data provider.
That just for your consumption.
Yes.
Inside, you should try to find out that, like, we used to find a very good initiative into this, that comparison, all that. There are certain funds which are recently has performed very well. I think that these outlier maybe have because the tenure is not so great.
Yeah.
So that you have an enough data. But if anything which is can be onto this, like outliers, or maybe that new ones which are performing good.
Yeah, definitely. We can look into it for sure. I mean, I don't think mathematically that would be that hard to do. We can probably look at the past 6 months or some kind of rolling period over the last 1 year or something, and see which ones are really outperforming everyone else. That's a great idea.
Even I have seen that in last 6 months there are good funds are not performing, but there are certain funds who has moved up in the quartile 2 to 1, and they are outliers over there.
Understand. Yeah. We'll definitely look into it.
Thank you so much.
Any more questions? Please let us know.
Ma'am, can we track the client's portfolio?
Yes. So, if you do have the premium version and if you have onboarded your RTA with us, which is a section which lets you onboard all your ARN registered clients onto the platform, you can as well view the portfolio of all your existing clients. And by portfolio, I mean we capture the current holdings of your clients only onto the platform. So for that, we take in two files, which is CAMS WBR4 and Carvi MFSD 203. Basis these two files, we capture the current holdings of all your existing clients and we show a portfolio analysis for the same.
Okay. So can we also analyze with the other funds or benchmark?
Yes,
To
meaning
compare these funds, for compare, if a client has five funds, I wanted to compare with the category or others in the same category with other funds.
sure.
It will be possible, no?
Yes. So in the portfolio section itself, we have this icon of compare, which then takes the component of the portfolio to this compare section, wherein you can add in other funds as well. You can add in the benchmark or for that matter, the category average too. So
Okay.
comparing of the components of the portfolio with any other fund or the benchmark that you're looking for also happens right here.
Okay. Is also rolling periods, rolling returns also shows? Can it track?
Yes. On a portfolio level as well as on a fund level as well, you could view the rolling data and all these tabs come up for every other component.
Okay. Thanks.
Any more questions? Please let us know. So if there are no further questions, we would end for today. Thank you all for joining in. You could anytime visit our YouTube page. We have a dedicated playlist for all the webinars that have been conducted up until now. Today's webinar will also be uploaded by next week. A total of 158 videos have been uploaded. Thank you all for joining in. Hope to see you again next week with a new topic. Thank you.
Thanks.